This is AHL Explains. I'm Anthony Ledford, and today I'm going to explain portfolio diversification. Today we're going to look at portfolio diversification, which is a really broad topic that underpins most of investment, and it applies to portfolios of hundreds or even thousands of separate investments. Now today we're going to keep things as simple as possible, so rather than deal with portfolios of that scale, I'm going to deal with a portfolio that's got at most 2 investments in it. And the first one I'm going to call A, and the second one I'm going to call B. And because I'm a CTA, or a managed futures trader, I can think about allocating a unit of risk into A or into B. Let's see what that would give me. So I put a unit of risk in A or a unit of risk in B. What return do I generate for that unit of risk? And let's assume that A and B are indistinguishable, and I'm going to give them therefore the same amount of return that I generate from that allocation of $1 of risk, being 0.1 here and 0.1. And the third column I'm going to look at is the return divided by the risk. This is like the Sharpe ratio. It's basically how much return you generate per unit of risk. And just dividing that by that, I get 0.1, and similarly 0.1 here. Now what I've got here represents the return on my investment of risk if I was to put all of my risk in A or B. Now in order to understand diversification, instead of putting it in one or the other, we need to understand splitting the risk over the different investments. So let's just see what happens if I put it equally between A and B. I put a half in A and a half in B. Then the return I would get from that portfolio investment would be half the return of A plus a half the return of B, which gives me 0.1. We need to think about what goes in here in the risk column, and in order to do that we need to do a little calculation. So first of all I'm going to draw a horizontal line of length a half, which corresponds to my half unit of risk placed in investment A. Now I'm going to assume that investment A and B are not completely correlated. And what that means is if I put my half unit of risk corresponding to the investment in B, and I attach that to the end of this line here, it will go off at an angle. It won't be in the same direction as the first line I drew. And so that would take me out to here. So this line is also of length a half, because it corresponds to the half unit of risk in B, but it's going off in a different direction to the investment in A. Now, the third side of this triangle, the length of that, is actually the amount of risk that would be associated with this portfolio investment. So let's have a think what the length of this line would be. Well, it's definitely going to be less than 1 because these two sides are not going in a straight line. And if you think about it compared to a right angle triangle, you know it's going to be bigger than about 0.7 as well. So this is some number, let's assume it's 0.8, and carry on with the calculations assuming it's 0.8. So I've got the return, I've got the risk, I can work out the return divided by the risk, and I get the answer 0.125. So at this point, let's just look what's gone on. I've split my unit of risk equally between A and B. I've actually got the same return here as I had in the individual investments, but the risk has actually gone down. And the risk-adjusted return has therefore increased. This is boosted to 0.125 compared to the individual investments here. That's extremely important. This is the diversification effect, and it comes from the fact that A and B, the sides of this triangle, are not both going in exactly the same direction. Okay, now something's happened here. We've actually reduced the amount of risk. If the amount of risk was something that we wanted to preserve, we've got to do something else to this portfolio to get this 0.8 back up to number 1. So that's called re-gearing the portfolio. So if I take the half in A and a half in B portfolio and I multiply that by 1.25, that would actually enable me to take my risk and scale that up to 1. So 0.8 times 1.25 gives me 1. The return I get also gets scaled up by this multiplicative factor, so that becomes 0.125. And the return divided by the risk, well, it's the same as what you had here. It's 0.125. That's extremely important. what we're seeing is that the diversification has boosted the risk-adjusted return. It's also reduced the amount of risk in the portfolio. To get back to where we started in terms of risk, I've then had to re-gear the portfolio. Now, if you go back to this little diagram we had here, if A and B were in exactly the same direction, so it would just be attaching a line of length 1/2 onto the same point, but it would be in the same direction, there would be no diversification. The third side of this triangle would be of length 1. The more the angle deviates between A and B from the straight line, then the more diversification you obtain. So high correlation implies low diversification, and low correlation actually implies there is more of a diversification benefit to be captured. So that marks the end of this foundations block, and we've covered momentum, volatility scaling, futures contracts, and most recently portfolio diversification. These topics are the 4 cornerstones of managed futures trading. Next, we'll be looking at risk, trade execution, and discussing a wider range of trading signals. Thanks very much.